So you're thinking about saving for retirement and you're unsure whether you should make Roth or pre-tax contributions. In this video, I'm going to cover some considerations to help you decide which option might work for you. Roth and pre-tax contributions are specific to types of retirement plans, like your employer's 401k. Many plans let you decide between making pre-tax contributions, Roth contributions, or a combination of both. First, let's define Roth contributions and look at some considerations for them. Roth contributions are where you pay income tax now as the money goes into the account. This means that any money you put into your retirement account as Roth will be taxed in the year you put it in. Once the Roth contribution is made, your money has the ability to grow income tax-free over time, assuming that you invest it. Once you reach retirement, you have the ability to take the money out income tax-free. You do not have to pay income taxes on Roth distributions in retirement, assuming that certain criteria has been met. Now, when are Roth contributions a good option? First, if you are currently in a lower income tax bracket or you are a younger saver, it may be beneficial to make Roth contributions. Your contributions are taxed at a lower rate and they have the potential to grow and be distributed income tax free. Being taxed at a lower rate now may be beneficial if you end up increasing your income and are in a higher tax bracket in retirement. Another good reason to use Roth is if you have a large existing pre-tax balance. It might make sense to add some Roth contributions. By adding Roth contributions, you provide a source of income tax-free money in retirement, and this could potentially lower your tax bill since you already have a big pre-tax balance. Now let's look at pre-tax contributions and some considerations for them. Pre-tax contributions are made with money that is income tax deferred. This means that the money goes in and you defer paying income taxes on it, hence the name, pre-tax contributions. Making pre-tax contributions reduces the amount of income tax you have to pay in the year the contribution is made. Once the money goes into your retirement account, it then grows income tax-free over time until you reach retirement. Upon reaching retirement, you will withdraw the money from the pre-tax account, at which point you will have to pay income taxes on that money. So, with a pre-tax retirement account, remember that you will pay your income taxes on the money when you take it out in retirement. You get the income tax deferral today, and then you get to pay taxes at some future point in retirement. Also, pre-tax accounts have a special feature where at a specific age, you have to start taking distributions. These distributions are called required minimum distributions, or RMDs, and you may have heard this term before. This is the age when you have to start taking money out of pre-tax accounts according to IRS law. Now, currently, most people have to start taking pre-tax distributions on or around age 72 or age 73. Now, when are pre-tax contributions a good option? Well, first, if you are in a high income tax bracket, it may be beneficial to defer taxes on some income by making pre-tax contributions. The hope is that by deferring income tax today, you can be in a lower income tax bracket in retirement when you eventually pay taxes. Another good reason to use pre-tax contributions are if you are on a tight budget. Pre-tax contributions leave more money left over in take-home pay when you compare that to making Roth contributions. In summary, let's look at Roth versus pre-tax side by side. For Roth, you pay income taxes today, you get income tax-free growth, and then you also get tax-free distributions in retirement. Roth is useful for younger savers or those in a lower tax bracket right now, and it's also useful for those with a large pre-tax balance. For pre-tax, you defer income tax today, you get tax-free growth, and then you're going to pay income tax in retirement. Pre-tax is useful for savers in a high income tax bracket, and it's also useful for those on a tight budget wanting to save for retirement. Remember that pre-tax accounts are subject to RMDs. If you're still unsure which option is best for you, then consider having a mix of both pre-tax and Roth contributions. For example, you could do 5% pre-tax and 5% Roth for a total of 10%. Each year, evaluate your current budget and income, and then determine if you need to make any adjustments. The important thing is to start saving and stay consistent with your retirement savings over time. For more personal finance content, please check out our website and YouTube channel. As a reminder, this video is provided for general education purposes only. It is not intended to provide financial advice specific to your situation.